and we are live. The market, Fed Powell is just wrapping up the conference, and the stock market is reacting. So, what was it that we wanted to kind of look at going into this meeting? First of all, there was a growing consensus that this was going to be a hawkish cut, which is that they were going to come in and say that there's a rate cut, but we're done. And that truly would be actually the bear scenario. If the market was done getting its stimulus, then that would have probably resulted in a downturn in the market. And the more bull case scenario was essentially that it's nowhere near as hawkish as the market was trying to price in, and the market just falls into the summer doldrums, vol compression, which essentially would be the more bull case scenario in the market, because the market holds up and allows different investment themes to continue to work in this environment. So what happened? Well, the Fed came in, and obviously there was a very divided Fed. There was a dissension amongst people that viewed that this cut was not necessary, but they did not rule out further rate cuts. And this is the key: is that they said obviously they want to assess the incoming data, monitor the implications, all the Fed language that comes in there. But basically, they're saying, look, if the situation warrants it, then there's room for one more rate cut or more in the first quarter of the year. The fact that they left that window open is critical, because that really takes the wind out of the sails of that hawkish tone that everyone was worried about. And of course, the moment you go from a hawkish positioning to things not being remotely as hawkish, I wouldn't call it outright dovish, but certainly the market was maybe pricing in far a Fed that was trying to kind of indicate that there's a real good chance they may have ended the rate hike cycle. If that was in any way the reality, the market would not have liked it. So the fact is, the market is taking a breath and actually reacting positively. So let's look at some of these charts. The S&P 500 is up 58 points. Let me just put it on a 1 hour chart just so you can see that reaction, but you can observe the market absolutely ate the on the upside. This actually is a positive break. It's going to get it into a multi-week close up here, and certainly the market, the Fed meeting at least is not going to be a bear catalyst. Now, one of the things I've been talking with my members is that since the correction itself was so shallow and short, that odds are here that this market is actually likely to hold up and even potentially go higher into the end of the year, because we're in a situation where we are well off trigger points. I mean, we're talking about needing a 4, even 5% drop in the stock markets for us to legitimately be hitting systematic trading triggers, other things that would perpetuate some sort of liquidity sell cycle. Market has a big cushion in a period where the volatility in the daily implied ranges have gone narrowed completely. We have a volatility index that's now in the 15 handle on the downside, literally now trading at the lows of the year. Or at least even just a stone throw away from the lows of the year. And so we have a scenario at this stage where volatility is narrowing. We're going into next week's option expiration, and next week's option expiration is got lots of gamma. When we're not in a danger zone, like we've moved away from the danger zones we talked about a month ago, and now that we're away from it, then that gamma actually more often than not acts as a pin, which is it compresses volatility and narrows trade ranges even further. This in itself can create bull flows. Overall, the market crawling up higher here is increased likelihood. Now, obviously, there is one last curveball. It's that jobs numbers coming out on Tuesday. And so, before we go and start doing a victory lap for the bulls, like they've already been able to persevere, we really got to make sure that that jobs numbers doesn't kick the feet out from under the market. On balance of probabilities, it's more likely going to be within the expected range. If that is there, then the month of December, you can basically write off as a trade range pinned market. Not only is there the big OPEX this next upcoming week, which is the option expiration cycle that causes the pinning, but the big options whale, the JP Morgan options whale, has the December 31st options pin gamma working that could keep the New Year's data also very narrow. So expect very little over these holidays in terms of these kind of volatility ranges. Now, if I was to suggest some initial targets that would be interesting, well, first of all, the markets have a tendency to love to gravitate toward even numbers, and particularly something like a 7,000 level is now very likely to be a magnet. It does make a lot of sense for the market to head there from a perspective of even a pain trade perspective, where the markets break to higher highs. They create new waves of complacency in this market, cause everyone to come down, and then things could really wake up in January. Nonetheless, okay, that's enough of that scenario. Let's just talk about some key things. First of all, I want to look here at the SOFR futures. SOFR futures are looking at the rates markets, and this is an hourly, so looking at the reaction on the Fed, you can observe here we had the SOFR futures rising, which is yields coming down in the reaction. That's showing that little bit of dovishness. You can also observe this is the 1 year SOFR futures going out to December 2026. Also, you can see that reaction over the last hour causing rates to decline. Clearly, I wouldn't call it a dovish positioning, but the Fed was nowhere near as hawkish as everyone feared. And so everyone's taking a breath and relaxing. What is this cause? Well, look at the long bond. You can see the 30-year Treasury bond upticking off of its lows. The 10-year bond very clearly upticking off its lows. Yields are coming down right across the board. What does it mean for the Fed path? Well, I'm just going to refresh this quickly here. But what we want to highlight is that we were down at like 72, 73%, jumped to about now 75% odds that the Fed is not going to move in January. There's right now only a 24% chance that the Fed is going to move this coming new year in January on the 28th. This is important to watch because one thing that we've now seen is that if you go all the way out to April of when Fed Powell is likely to relinquish his seat to a new Fed chair, you have a scenario where right now there's still a 40% chance that we're not going to see a rate cut by that period. But this has actually increased, that there will be at least one rate cut, 43%. It was actually flipped earlier. So now you can see there's increased probability that in the first quarter of next year that there will be one cut. It'll be very interesting to see on that jobs number. We'll go live stream again on the jobs numbers to see whether any of these things have actually materially pivoted. Okay, so let's focus then here. Now that we've seen what the rates markets have done, let's kind of break this down on some of the other key markets. First of all, again, S&P 500 about to break to a week high on the little bit of a breather. What does it mean for the dollar? Well, the dollar weakened. Obviously, a dovish positioning and potentially lower rates is something that generally weakens the currency. You can see this downtick. Is this the beginning of a new leg down in the dollar? Well, I'm not so sure yet to write off this market. My key level is 98 on the Dixie. At this moment, even a drop here of another 25 or 30 cents between today and tomorrow is not going to be enough to make me get rattled by the dollar index. But a break below 98 would be incredibly troublesome for the dollar, but it would have great bullish implications on the reflation trade assets, international equity markets, commodities, and all sorts of other areas like this. And so let's see whether or not between today and tomorrow, when we see both the Asian and European markets absorb all of this, whether these first reaction trends that we're seeing actually continue through the overnight markets into tomorrow. The other thing to highlight is obviously once a little bit more dovishness comes in the market, it has certainly allowed precious metals to take that well. Gold up $25, working its way towards some of the upper ranges of its 1 week trade range. But the key one here is silver up a buck 30, just continues to rip with this breakout as flagging formation. We're at a pretty interesting short-term level. If silver can crack through this $62 level, the next wave of measured moves are all the way up to $70. This is a hot market. It's working well. And more importantly, it is literally going parabolic. And that is usually a sign of heavy flows coming in there, acceleration of trend. And so silver continues to be a hot market. And the fact that we're seeing a weaker dollar, gold doing well, really a lot of things are not in the favor of silver. So watch whether silver can actually keep that momentum going into the new year. And so that's pretty much a good sizing up of what's going on. This really, again, will come down now to the to the the jobs numbers that are going to be coming out next week. Clearly, the Fed did not create the troublesome hawkish stance that everyone was worried about. That means that the Fed is not, at least at this moment, in the way of the markets. And so we now just need to get through that jobs numbers hurdle. If the jobs numbers do not kick the feet out from underneath the market, you can pretty much bank that this is going to be like watching paint dry for the rest of the month. There will be generally a bullish tone to that paint drying, which is that the market could slowly crawl, but it's going to be in very tight daily ranges. The idea of these 100 S&P point rips on the upside in a day are very unlikely to happen if the gamma pinning prevails. And so it's going to be a scenario where this month anyway is not going to be where there are going to be big stresses. Let's see how it plays out. We will be live streaming that jobs number on Tuesday, so make sure you stay tuned for that. We'll be giving you the play-by-play on what the impacts are to the markets on that. And of course, we're going to be looking at what implications this has had on all the different markets over the overnight in tomorrow's sessions that I do with members at Big Picture Trading. Links are in the description below if you want to join me for one of those sessions. So this is where we'll wrap it up. Clearly, the market taking a sigh of relief. The pressure is taken off from this, and so no immediate reason bearish. We'll see how it overnight